Good evening. Welcome to LSBF Study Interactive live revision for ACCA F9. First of all, let me apologise to those of you out there who were expecting a slightly older gentleman who was taking the tuition course. I am the official tutor for LSBF for F9, and he was just standing in for me. Hopefully he hasn't let any gaps appear and that you are well prepared. We are here on revision. So those of you that are watching this for the first time need to be aware that you're already expected to have some knowledge of this F9 paper. Here this evening we'll be taking that knowledge and applying it to past exam questions, demonstrating to you how you can succeed in this paper. Now, I'm a firm believer that F9 is highly achievable, so long as you're well prepared and you have the right technique, the right amount of knowledge, and crucially, the right strategy to succeed. Let me explain. This paper is rather predictable. It is based around 3 sections. In section A, we have 15 small individual multiple choice questions, which works a total of 30 marks. In section B, we're going to have 3 scenarios. These scenarios are likely to be centered on certain topics and will each contain 5 multiple choice questions which are based upon and will be using the information provided in the mini scenario. And then we have section C, which is 2 large questions, again taken from certain parts of the syllabus. These larger questions are likely to comprise both calculations and critically written parts to them. Now, for me, there is a way in which you can approach this paper that maximizes your chances of success. In your exam, in this syllabus, there are 5 critical, 6 in total topics. And we know, because the ACCA have informed us, that only 3 of those will be applied in section C. Those being working capital management, investment appraisal, and finance, which will incorporate cost of capital. This is therefore your golden area. These elements you must be entirely convinced by. You must be entirely capable and highly able to produce excellent answers. Not perfect, but excellent answers, because this is going to give you the core to succeed. As you move into section B and A, we will also find the investment appraisal, working capital and finance in these elements, but it is here that the ACCA will introduce to you the lesser known topics, the topics that perhaps cause you a little bit more distress: foreign exchange, valuations, and the financial management function and environment. Now, my guidance is, to succeed in this paper, you should perhaps start in section C, and subsequently, I advocate that you do the paper in reverse. I say this with many years of knowledge based around the F9 and the evolution of the F9 exam. If you are able to answer section C with excellent answers, which should be possible because we know the syllabus topics that will be coming up there, then you provide yourself with a very strong basis of success. Now, I want you to overperform in section C to compensate for what will be a trickier section B and A. After you've completed section C, I believe that you should then go to section B, and here you're going to have 3 scenarios, and they're going to be perhaps on topics that you would be the first to admit are not your favourite. Valuations, for example. But my suggestion is, of each of these scenarios, if you can pick up 2 out of 5 correct, picking up a total of 12 marks from section B in total, combined with the excellent score within the region of 28 to 30 in section A, then that alleviates the pressure on yourself as you come into section A. Because section A tests the boundaries of the syllabus. And here you will find questions that are going to cause you some concern. But nestled within these are often questions that are very straightforward. And I would therefore suggest that you should be able to get 4 to 5 of these accurate. And these will be the marks that carry you over the magical 50. Across the next 4 evenings, we're going to be looking at the syllabus, and I'm going to be demonstrating predominantly bigger questions, but also some multiple choice questions where we can, how to tackle the F9 exam. I'm very open, and I would encourage you to communicate via your chat button if you have any issues or any uncertainties that you are experiencing as we're working through. I would also ask you to have available certain past exam papers so you can follow and read, and you can find these by Googling past ACCA F9 exams. This evening I'm going to be using the exam papers that are the June 2015 paper. We're going to be using the December 2014 paper. We shall be using the December 2015 paper, the June 2014, if time I must add, and finally the June 2015. I have selected questions which I believe cover the syllabus. Now, this evening we're looking at sources of finance and cost of capital, critical topic for your success. I have made available, hopefully you have found this on your Canvas platform, the following document which I have put together just to give you a sense of perspective of the syllabus that exists here at F9. So what I have intended to do, and I'll explain my rationale, is create a flow where we deal with perhaps the more complicated parts of the syllabus first. When I say complicated, that is not to do any part a disservice, it's from my experience the areas in which students struggle. So this evening we're going to be looking at business finance including cost of capital. When we meet on Thursday, my plan is to look at valuations and risk management. Next Monday, we'll start getting to the topics that you're more familiar and comfortable with, which is working capital management, and when we conclude a week on Thursday, we'll deal with investment appraisal, normally an area of strength. So, who am I? This is me, Joel Romaner, if you've not met me previously. As I stress, I do all of the classroom-based F9 here in London, and I also teach a bit of P4 as well. So I'm fairly confident of my ability here with financial management. Now, what this document provides you with is just a summary of the syllabus. And this evening, let's have a chat through and use this opportunity, if you will, to challenge me on any topics that you feel uncertain. But the areas in which we're going to, and you know, I like to do questions with you that I think are complicated. I'd rather you do the more straightforward questions alone. I don't see the value, and this is just my feelings, of giving you a full sense of security by doing the more straightforward questions in these sessions and then leaving you to your own devices to tackle more complex questions. I'm here to add value and to deepen your understanding. Subsequently, the questions I've selected, whilst they give us both syllabus coverage, I believe there may be some challenges for you that I hope to address. Now, let's talk about short and long-term sources of finance. You must be aware of what they are, and clearly overdraft, short-term loans, your working capital in the form of payables and operating leases, I would guess are obvious to you. There may be a time where you're asked to explain the characteristics in a written question, so please don't disregard this knowledge. You also need to understand what are long-term sources of finance, and for a large listed company, we're normally looking at a combination of bank loans, tradable loan notes, which could be irredeemable, meaning they're never repaid, redeemable, which means they have a maturity date, or convertible, which means at the time of maturity, or perhaps before then, we would be looking at converting into equity. You should be aware that they are all sold normally, unless otherwise stated, in units of $100. Bear with me a moment. So they are sold in $100 units. You need to be aware as well of your equity and you need to understand when new equity issues occur. You need to understand what a rights issue is, which is selling new shares to existing shareholders. You need to be able to calculate the TERP and also the value of a right. We also have in the past seen questions relating to placing, stock exchange listings. So these are theoretical aspects that you would need to be able to discuss in section C. In terms of a nice F9 historical question which centered around what considerations, what factors should you consider when choosing between debt and equity, this could talk about the cost. Debt always is cheaper than equity because the risk is with the business, whereas with equity the risk is with the investor. We could talk about the security required. We could talk about covenants which may restrict us from accessing other sources of capital, the attitude towards risk and the availability of finance. You need to be aware of financing a small or medium-sized enterprise and the constraints they face and the issues that restrict them from accessing long-term debt and equity. So if the examiner was to ask you how would these businesses finance themselves, you'd have to come up with some alternatives, such as business angels, venture capitalists, government grants, sale and leaseback, and the more modern approach of crowdfunding. You need as well to be aware of Islamic finance. Remember, Islamic finance is a rapidly growing area, sources of finance, where the concept of interest, riba, is banned. And instead, the investors engage in a form of partnership where a return has to be generated by the business in order to enhance the wealth of the investor. I've then listed, and please forgive these page numbers, what perhaps I should have done for you here, and it showed you which exam page they come from. These exact revision kit, you have access via Canvas to a revision kit. These are my recommended questions and their page number. These questions here are from exam questions that are found from, I believe, 2014 to 2016 from the ACCA website. And I strongly advocate you download those questions and you practice as many of them as you possibly can. Tonight I have selected one of these questions called KQK because it's going to enable us to look at the impact of a finance choice, and it's also going to discuss weighted average cost of capital as the discount factor. This evening we will also be looking at the cost of capital and capital structure, which forms part of finance. You guys must be able to calculate the weighted average cost of capital. You need to understand the distinction between market and market value and book value, and the way in which the book value distorts the equity weighting and subsequently provides you with a lower cost of capital. You need to be able to calculate market values, the cost of each source of finance, and combine. With regards to calculating the cost of equity, you must be capable of doing the dividend valuation model and the capital asset pricing model. You need to be able to explain the weaknesses inherent in both of these models and perhaps suggest which of these is the better measure of the cost of equity. You need to be aware of the systematic, the unavoidable risk, and the unsystematic, the avoidable industry-specific risk. You need to be able to calculate the cost of a debt instrument, which is always post-tax for the business. Preference shares are treated as debt and will be based upon the dividend growth model, but without growth because the preference dividend is fixed. You need to be able to calculate the bank loans, the irredeemables, the redeemables and the convertible, and we will hopefully look at as much of this evening as possible. You also need to be aware of capital structure theory, and with capital structure theory, understand the Modigliani and Miller's assumptions behind the no tax theory, which suggests that the weighted average cost of capital is independent of the capital structure. The capital structure has no bearing on our weighted average cost of capital, and then subsequently they're with tax, which says it is, and subsequently as a company gears up, they will reduce their weighted average cost of capital. You need to understand traditional theory, which says there is an acceptance from our equity investors they will tolerate a degree of debt, but too much debt and the cost of equity will rise. Too little debt and we're not taking advantage of debt as a cheap form of equity, of a cheap form of capital, I should say. Finally, project-specific discount factors. We will look at these this evening, which are used when the business risk changes, and subsequently you have to be able to de-gear and re-gear. Questions this evening that I've chosen that we will work upon, and once again this revision pack here is the exams from June 2014 through to December 2016, and subsequently I have selected GRENARP, which inherently is about shareholder wealth maximisation but capital structure. We will definitely look at DINLA, and then we will also look at FENCE, potentially even if time allows we'll do TINEP as well. But I need to make sure that you are following with me as we are working our way through. Let's start then with KQK. Now you will find KQK on the ACCA website, so let me get you a moment or two. It's the one that says September-December 2015. And this paper, September to December 2015, is available on the ACCA website. So please go there now, download it, and then I'm going to advise you of the question I would like you to read. Okay, hoping you've got that, I'd like you to go now. And my style, guys, is not to tell you everything at the outset. I want you to immerse yourself in this question. I select questions that I feel are a challenge. So please now, for 5 minutes or so, have a read of this question and have a think about what is required of you. I'm going to leave you for at least 5 minutes, and I want you to start mapping out and actively considering the issues in this question. I'll see you in 5 minutes. Okay, did you see how I was reading that question? When you read a question, don't read it passively, because information will just slip over you. Read it as if you are analysing every single word, as if your life depended upon it, because there is often things contained that you could easily miss if you read passively. They want to raise 20 million to expand their business, and they're going to get 8% loan notes. Immediately in my mind I think of 1.6 million, which says next year it's going to be 1.6 million higher if they take on those loan notes. As I read through the financial statements, there was nothing that stood out. But when we came down here, we were informed of income raising by 5%, of 40% of cost of sales being fixed, of the remainder, therefore 60% being variable, that will increase in line with income. We were told the tax rate is 30% and that they have a policy of paying out 40% of the dividend. We are told the current liabilities are given 3%, and then we are given average values of other companies similar to KQK. Well, if this is given as an average, we must be repeating these calculations not just once but twice. We're going to be repeating these for both our current and our proposed position, because herein lies the skill. The requirement says assess the impact of financing the business by the loan note on the financial position, the financial risk and shareholder wealth after 1 year. Now, financial position is really looking at our gearing, essentially, and it will also be looking at our statement of financial position, our assets and our liabilities. The financial risk we should really assess with our interest cover, but we will also assess this with the operational gearing. Now this is where it becomes slightly problematic, because it's asking us to consider shareholder wealth. Well, we will use return on equity and we will use the dividend. But in truth, the real thing that looks at the way in which shareholders' wealth increases is the share price. And in this particular question, we have no such information. So perhaps I'm going to add one other calculation, and that would be the earnings per share. And we would need to do what I would suggest first of all is our calculations as an appendix. I will come on and talk about part B in a moment, but if you've had a glance, you're unsure of the requirement, just bear with me on that one. So my appendix, first and foremost, is going to restate that position in 1 year. So this is question 4, KQK, from the December 2000 and the September-December 2015. Appendix. Restated financial So my income will be 140 million multiplied by 1.05, which gives me 147.0 million. Next, I'm going to show my variable cost of sales, which is 112 million times 60% times 1.05, and that gives me, let's double check this figure is correct, 112 times 0.7 times 1.0, take that back, 112 times 0.6 times 1.05, I'm looking at 70.6 million. Now, earlier, or just a moment ago, you saw that I suggested operational gearing. And operational gearing, we're told, requires contribution. So I'm going to do contribution. Contribution here is therefore 76.4 million. This is all in dollars millions. Now I'm going to show my fixed cost of sales, which is that 112 million times 40%, which is 44.8 million. And that gives me my profit before interest and tax of 31.6 million. Subsequently, we're going to have to charge our interest, and I've already stated the current interest of 2.8 we assume will continue, and we add 8% times the 20 million. That will take us up to 4.4 and bring us to profit before tax of 27.2 million. Our tax is 30% of that figure, which rounding up is 8.2 million, and that gives me profit after tax, better known as earnings, of 19.0 million. Now our dividend that we pay is 40%, so 7.6 million is our dividend, meaning we've got retained earnings of 11.4 million. And that 11.4 million is crucial because that's going to be added, sorry you can't see the back of my head, that's going to be added to our statement of financial position, which we shall now restate. What can we see there? We've got ordinary shares, which will not change because there's been no mention of it. That will remain at 25 million. But we've got reserves, which has increased. Our reserves were 118.5, but I'm adding 11.4, which is this figure here, to take us up to 129.9 million. Giving me total equity of 154.9 million. I have non-current liabilities. Again, I apologise, remind myself to knock the back of my head. Non-current liabilities, which were 36, but we've just acquired a 20 million loan. That's taken us up to 56 million. And our current liabilities, we are told, will increase by 3%, taking us up to 39.4 million, giving us a total of 250.3 million. Now, we have the essential information that we require to calculate our financial ratios. So what I shall do is we've got the debt to equity ratio. Debt to equity, the industry average is 30%. Our current position and our proposed position. Now our current position, debt to equity, we have 36 million and we had equity of 36 million, we had equity of 143.5, 25.1%. Now what we're going towards is we're increasing that. So we were, by the way, below the industry average. We had scope to enhance. We're now looking at 56 over 154.9. Which is 36.2%. So financial position, our capital structure now has more debt, which we kind of expected. The interest cover The industry average, that's the industry average, was 10%. Now, previously, our profit before interest and tax was 28, our interest was 2.8, that was 10. We are now looking at interest, or rather profit before interest, going up to 31.6, but most of that, well, not most of it, 31.6, a proportion of that is absorbed by the increased finance charges. So 31.6 profit shared by the 4.4 interest, we dropped to 7.2. Now this is a classic F9 situation here. Prior to acquisition of debt, our business was low financial risk. Subsequently, after the acquisition of the debt, we're higher financial risk. But by taking on this higher financial risk, what we want to achieve is to enhance the wealth of our shareholders. We don't have sufficient information to come to a definitive conclusion, but we got pointers in the right direction. Now, just before I get there, we need to do our operational gearing. The contribution divided by PBIT was 2. Now, the contribution that we have currently is 140 million minus the variable cost of sales. 112 times 60% is 67.2, less than 140. We've got contribution of 72.8 and we have profit of 28. So 2.6 was our operational gearing. That then subsequently falls to the figure that I just showed you here. Our contribution is now 76.4 and we divide that by 31.6, it's reduced to 2.4. So 76.4 divided by 31.6 is 2.4. Our operational gearing is looking at the way in which fixed costs form part of our total costs. Our variable costs have risen, which means our operational gearing has reduced because the fixed costs have remained as they were, thus reducing our business risk. Our return on equity, the industry average is 15%. This is where we're letting ourselves down slightly because our earnings, our profit after tax was 17.6 and we had equity of 143.6, giving us 12.6%, or sorry, 12.3%. We've now increased our earnings to 19. The equity has in fact risen by the retained earnings, and we retain that 12.3%. So this increased risk has actually not done too much for our equity investors. In terms of the returns, it's exactly the same, but that's why we're going to break this down now. And I suggested we're going to look at the dividends. Well, there's no industry average dividend per share, but the dividend previously would have been 17.6 times 40%, 7.04 million, divided by the number of shares in circulation, which is 25 million. So we had a dividend per share of approximately 28.2 cents. We now paid out a dividend of 40% of that 19 million, 7.6 million, and we still have the same number of shares. So we've actually increased our dividend. There is the increase in shareholders' wealth. Finally, our earnings per share, which there is no industry average, well, our profit after tax was 17.6. So our earnings per share was 70.4 cents. And it's now gone up to 19 million. Gone up to 76. So, financial position, risk, and shareholder wealth covered. We need to put this in an articulate I don't want to see you writing what the numbers, or I don't want to see your commentary just simply be repetition of numbers. That's not a commentary. Our commentary must say something along the lines as follows. My little subtext heading here ensures that I'm addressing each part of the question. One further comment here. Now, I'm deliberately avoiding any number. I often see commentaries from students that will simply say, our debt was 25%, it's now 36%. That's not a commentary. This is a commentary. It's not the most brilliant linguistic commentary, but it's a mark scoring commentary. Please refrain from telling us what the numbers have already told us. Now, finally, shareholder wealth. Okay, that for me is part A over. You notice the way and the style in which I do my commentary. I'd advocate that you do the same. We're going to detach from that and we're going to go and look at part B. And in part B, what we've got here is a requirement that I would say is fairly standard material that is frequent, perhaps not, but a standard bit of knowledge regurgitation that you would be required to have. So let me just get rid of these. Let's get rid of this stuff for a moment. Discuss the circumstances under which the current weighted average cost of capital of a company could be used in investment appraisal. And indicates a further part of the requirement, briefly indicate how its limitations may be overcome. Now, in your exam, in section C, my guidance is that you should be aiming to get as close to 100% of your calculations correct as possible and approximately 50% of your written marks. That will ensure that you are performing excellently in section C to give you that position to succeed in this paper. Now, what I am often aware of is students will write a bullet point answer, or perhaps for 5 marks they will write 2 sentences. Inadequate. You've got to appreciate, and therefore you've got to plan, 5 things to say. Discuss the circumstances under which WACC should be used and how do you overcome. Well, here we go. Here's my plan. Used, overcome. Your plan should be simply enabling you to stretch and expand your answer to score as many of those marks. Well, first of all, WACC is always used, except where 1. The finance risk changes, and for that we use something known as adjusted present value. 2. Where the business risk changes, and for that we use the project specific discount factor. Thirdly, we should not use it if the project is not financed from central funds. Now, I have subsequently thought about this, and I am aiming to score 1, 2, 3, 4, 5, with a little backup, 6 marks here. You've got to look at the number of marks and tailor your answer accordingly. 2 things to be said for a 5 marker is not acceptable, and by contrast, 5 things said for a 2 marker is inefficient waste of your inefficient use of your time. Now, writing this up, guys, that's just, you've got your plan, think, don't just start writing and allow your minds to wander and amble along. Think carefully about all of the things that you shall be saying. So, once I've thought about this, we go about producing our written answer. Now, in the interest of time, I'm perhaps going to just streamline this ever so slightly, but what I would say is my introduction. And my introduction would be that WACC is always used as a discount factor in investment appraisal. Okay, you just expand that sentence, please. Then I would say exceptions. 1, where the finance risk changes, as a consequence of the project. And that is overcome by calculating the adjusted present value. Number 2, when the business risk changes as a consequence of the project, and subsequently we would find that investors demand a different return and so we overcome this issue by calculating the project specific. It did say briefly, so you don't need to go into depth explaining the steps. We'll do that in another question. And then thirdly, where the project is not financed from central funds, we overcome Now again, see the way in which I converted my plan into a written answer. Please accept my apologies. That is not a full-blown written answer. You need to expand it somewhat. But I want you to see how I've targeted my marks by talking about the exceptions and then how we overcome those issues. We're going to move on from this question. We are going to look at another question which challenges you guys, and it's a real tough question which I hope to deconstruct for you and get you to appreciate how we would attempt such a question in an exam. Let's take you to the exam itself. Is June 2015. So please go to the ACCA website and call up the June 2015 exam. And once you have, I'd like you to go to GRENARP. I'm going to leave you to call this up, and again, 5 minutes please guys, have a read of this question and think how we could possibly tackle this. Over to you. Okay, how are you finding this one? This one is a tough question and I thoroughly enjoy it. Again, it's from the finance angle. Granat, our company in question here, is planning to raise 11.2 million through a rights issue. A rights issue is where you offer new shares to existing shareholders. The rights issue will be discounted at 20% to the current share price of 350. So actively reading 350 times 80%, 20% discount means investors will pay 280 for a share. Fine. The rights issue will be on a 1-for-5 basis and issue costs will be 280,000. This will be paid out of the cash raised. Just whilst I'm here, 11.2 million divided by 2.80 tells me that there will be 4 million new shares, which must tell us, if we multiply that by 5, that we have 20 million shares currently. And we can verify this by using this information here. What are we doing with this money? Are we using this money to fund a new expansion or a new project of some sort that will increase shareholder wealth? No. We're using this money to redeem part of our loan note issue. We're asking equity investors to recapitalise the business, to change the capital structure so that we have more equity and less debt. Each loan note has a nominal value of 100. That's all very well and good. A current market value of 104, but there is a clause in the bond issue contract that allows Granat to redeem the notes at a 5% premium. 104 times 1.05 gives me 109.2. Okay, actively reading the question, $109.20 means that we can repurchase that $100 loan note at any time prior to their redemption date. The price-earnings ratio is not expected to be affected by the redemption of the loan notes. Well, what is our price-earnings ratio, I think? It is 350 price-earnings ratio, current share price divided by earnings per share, 8.33, I believe that comes out at. Yes, 8.33. Total earnings for the year were 8.4 million and the company pays corporation tax at 30%. So we've engaged, we've got our clause into the question. Now we see they're asking us to evaluate the wealth of shareholders by using the net rights issue funds to redeem the loan notes. How in this instance are we going to understand the impact on shareholders' wealth? Well, this question requires us to compare. Let me just make a note of this. This is question 4, Granat, which is from the June 2015 exam. Part A. What is the effect on wealth of shareholders? What we need to do here is we need to compare not the current share price, but we need to compare the theoretical ex-rights price with the revised share price. And the theoretical ex-rights price will be used as a benchmark because if you recall, after a rights issue, exactly after the rights issue, the investor's wealth does not change. Because what is occurring there is the investors have put in cash to buy new shares. The cash price or the value of the share will subsequently reform to provide them with the same wealth as previously. But we are looking at the revised share price. Now the TERP we can calculate. The revised share price will be established how? Well, the clue is the examiner says the price-earnings ratio is not expected to change. So we're going to have to find a revised earnings per share and multiply it by our PE ratio. How do we do the TERP? Well, we can do it one of two ways, but I'm going to do it in this fashion. Existing shares in circulation are 20 million. And the current share price is 350. gives us 70 million. The new shares to be issued, I indicated to you before, was 4 million. At the 280 is 11.2 million, giving us 81.2 million and 24 million. Thus, our TERP equals 81.2 million divided by 24 million, 338. Sorry, yes, 338. $338. That's our comparator. Now, what we're going to go away and do now is some workings. Our revised earnings per share needs revised earnings divided by the new shares in circulation, or the total shares in circulation post rights issue. Well, the total shares that will be in circulation are going to be 24 million. The revised earnings is going to be the current earnings, which we were told in this question is 8.4 million. Let's do this in dollars per thousand, plus the interest saved minus the additional tax. That would give us our revised earnings. Now, we currently have a book value loan notes of 30 million. For each, well, let me show you one thing first. The net cash raised to repurchase the bonds, the loan notes, will be the gross funds of 11.2 million less the issue costs of 280,000. We have raised 10,920,000. If I multiply that by 100, which is what we're buying back, but divide it by the 109.20 that we must pay, this will come to 10 million. We will be able to repurchase 10 million nominal value loan notes. Which at 8% is the interest we're going to save. So the interest saved is 10 million times 8% is 800,000. But that will incur additional tax of 240,000. And thus 8.4 million plus 800,000 minus 240 gives us revised earnings of 8,960,000. 8,960,000. Excuse me. Apologies. 8.94 million shared by the 24 million shares in circulation means that our revised earnings per share is now 37.3. The revised share price that we're looking for, 37.3 times the PE ratio of 8.33, will give us a revised share price of 311. Evaluate the effect on the shareholders' wealth by using the issue funds to redeem loan notes. It has declined. This is not a worthwhile option to follow. It's declined by 27 cents. I'm sneezing because I've turned the air conditioner on and I've turned it on too high. Let me turn it off. Okay, I'm going to leave that to digest for a moment. Okay, no questions? Let's do a little bit of a recap here. Capital structure theory. Three scribbles which may look like three E's to you, but they're not. They are the graphs that we plot for capital structure theory. And what I have done there is I'm trying to jog your memory of traditional theory, Modigliani and Miller no tax, and Modigliani and Miller with tax. This diagram here is in fact Modigliani and Miller no tax. That there is the WACC, the cost of equity and the cost of debt. And what they argue with their no tax theory is this. The capital structure has no bearing on the weighted average cost of capital. The weighted average cost of capital remains constant and is a consequence of business risk. Here, this is what we call traditional theory. And in traditional theory, the cost of debt and the cost of equity will always be more expensive than debt. If we take on debt, initially we will reduce our cost of capital and find this optimal capital structure. Beyond which, as we continue to introduce debt, we will increase the WACC because the equity investors demand higher returns, and thus we move away from our optimal capital structure. Our optimal capital structure being the composition of debt and equity that minimises our weighted average cost of capital. Because our weighted average cost of capital will benefit the organisation by being brought to a minimum. Future investments will become more attractive and the value of the business will rise. Here, this is Modigliani and Miller with tax. And what they're arguing here is that the cost of debt with the tax shield applied brings down your weighted average cost of capital, so they advocate maximising debt in your capital structure, thus ignoring the risk of bankruptcy. This is an application question, and what you guys are required to do, sorry, wrong one, which one are we looking at? It is June 15. What we are looking at here is whether or not, and this is important, discuss whether Grenarp might achieve its optimal capital structure following the rights issue. If you were to engage in this question and simply regurgitate capital structure, you'd score some marks, but you wouldn't score all of them. If you were to blend in the situation following the loan issue and discuss the company in question, you would score maximum marks. So how best to answer this? Well, first of all, my advice would be to have an introduction which explains the optimum structure. Explain the optimal capital structure, indicating this is where WACC is minimized and where the value of the company is maximized. Not maximized, let's increased. Score 1 mark for demonstrating you're aware of the optimal capital structure. Then I would introduce Modigliani and Miller no tax, and I would simply explain their theory. Explain the theory, which is that the capital structure has no bearing on WACC. Rather, WACC is aligned to the business risk. Subsequently, I would then discuss GRENARP, and GRENARP it's retained because it won't change. We already have the optimal capital structure. I would go on and talk about Modigliani and Miller with tax. And again, I would explain this theory that the optimal structure achieved by increasing gearing and debt levels. And subsequently, in the context of GRENARP, they will move away from their capital structure. And then finally, I would talk about this traditional theory. But the thing with GRENARP is we don't know what's going to happen. So it depends really where GRENARP currently is. If investors, equity investors, when I say restore, it will move towards, and if Now, importantly, what I want to demonstrate to you there is I haven't just recited each of those theories, I've applied the company in question. That is how you would stretch to score your 7 marks. Folks, it's 7:25. I'm going to take a 10-minute break. When we come back, we're going to discuss the cost of capital and look at some questions that enable us to calculate the weighted average cost of capital. I'll see you back here in 10 minutes. Let's put the kettle on and get ourselves ready. See you then. Okay, let's get cracking. So, Lorraine and Mwemba, I know you're there. You're just not talking to me. We're going to start doing cost of capital. We're going to do a weighted average cost of capital. So I'm going to ask you guys now to go to a question that is from the March-June released paper. Question number 4 from March-June 2016. This one. If you can call that up from the ACCA website, I'm going to ask you to go down to question 4, which is known as DINLA. Have a look and have a read, and I shall show you how we'll generate the answer to this question. Lovely to hear from you. It's always lonely standing here, Mwemba, so I know you guys are watching me because I can tell when I nip outside. Any issues, any questions, type away. Same for you as well, Lorraine. Okay, I've selected this question because there is 4 different types of finance, and it's therefore comprehensive in terms of our coverage. We've got ordinary shares. We need to calculate the cost of equity. We've got preference shares. We need to calculate the cost of our preference shares. We've got loan notes, which we're subsequently told down here are redeemable. So we're going to calculate the cost of debt, and we've also got a bank loan. Now, guys, everybody has their own take on things, and this is my take, and this is the way I think you should calculate the weighted average cost of capital. So, question 4 from the June release of 2016. This is called DINLA. And part A, 3 steps to calculate the weighted average cost of capital. Now, please appreciate my methodology is designed to ensure you don't drop a single mark in the exam. It's not necessarily the quickest way, it's the most productive way. So, number 1, I always advocate that you calculate the market value of your finance sources. And then number 2, I suggest you calculate the cost of each finance source. And number 3, you combine, not using the ACCA provided formula, because errors can arise from using that. Rather, I'd like you to deconstruct and do it in the way I'm about to show you. Now, the market values, simply for ordinary shares, the book value is 23 million. They have a par value of 25 cents, which means we have 92 million in circulation, each currently trading at 426, which gives us 92 million times 4.26, 391.9 million. For our preference shares, they have a book value of 5 million. They have a nominal value of $1. That gives us 5 million shares, each trading at 56 cents, which gives us a market value of 2.8 million. For our loan notes have a book value of 11 million, but they are trading at a slight discount of 95.45 per 100, giving us around about 10.5 million. And finally, the bank loan doesn't have a market value because it's not traded. The bank loan we'll just use at 3.0 million, giving us $408.2 million. Okay, get that out of the way. There's normally marks attached. We then go to step 2, the costs. Now, the cost of equity in this question requires us to use the dividend model. The dividend model is the dividend multiplied by 1 plus growth divided by the price of a share now plus growth. Well, the beauty of this question is we are told a dividend of 25 cents has just been paid. And we're told it's expected to grow by 4%, and we are also told the ex-dividend price is $4.26. Gives me a cost of equity of 10.1%. Can you see that? That's 10.1%. We're going to repeat this for the cost of a preference share, but without growth. And the dividend is $1 times the 5%. So it's 5 cents divided by 56. That is 8.9%. Next, I'm going to do the cost of the bank loan, which is simply the interest paid by the bank loan multiplied by 1 minus t. Well, the interest on this bank loan, we are told, is 7% multiplied by tax of 25%. That will give us 5.25%. We have done the more straightforward elements first. Now what we're going to do is we're going to calculate the cost of debt for the redeemable. And I advocate the following 4 steps. Step number 1, calculate the interest paid per annum post-tax. Number 2, calculate an NPV at 5%, which is essentially based upon the market value as a cash outflow, the interest as an annuity, and the redemption value as a single one-off discounted cash flow. Step 3, if 5% is positive, then calculate the NPV at 10%. If, however, it's negative, then calculate the NPV at 1%. Again, I'm doing this based upon my experience in the exam and ensuring you avoid losing marks. Step 4 is to apply the IRR formula to steps 2 and 3. So let's see this in action, shall we? We have got a loan note of 6%. So step number 1, $6. If you're wondering why it's $6, because it's based upon its nominal value. 6% times its nominal value of 100 multiplied by 1 minus t gives us our figure of 450. and that's going to be paid every year up until the date of maturity, which is in 5 years' time. So step 2, NPV at 5%. Well, in year 0, the market value is a cash outflow at 95.45. In year 1 to 5, the interest that we calculated in step 1, 450, will be paid every year for 5 years. And in 5 years, we're told this is going to be repaid at its nominal value. So the cash flows are going to be discounted at 5%. Needs a set of discount tables. 5%, 5 years, annuity factor is 4.329. 5 years, single discount factor is 0.784. So our discounted cash flow is 95.45, 78.40, cash outflow of course, and 19.48. And that's come in at 243. So my third step, as it's positive, as I've set up here, if it's positive, we're going to rediscount at 10%. So my MPV at 10% will rediscount these cash flows. My discount factor at 10% will be 1. Naught 0.621 and 3.791. So 450 times 3.791 gives us 1706, 6210. $16.29 negative. Now, the IRR formula, which you should be familiar with, equals L over plus NL over NL minus NH multiplied by H minus L. If you have any concerns, L is the lower discount factor. Well, the lower discount factor we used here is 5. NL is the MPV at the lower discount factor, which was 243. And minus a minus becomes a plus. H is the higher discount factor of 10 minus the 5. So 2.43 shared by 2.43 plus 16.29 gives me 0.129 times 5 gives me 0.649 plus 5 gives me 5.6. That's what I'm going to declare, 5.6%. In an exam, you would score 3 marks for this. 1 mark for the interest, half a mark for each of your MPVs, and 1 mark for the IRR. Take your time and do it carefully. There's good marks available. We are now in position to consolidate. And as I stress, I choose not to use the WACC formula in the exam sheet, but in step 3, for the WACC, what I do is I do it individually. The cost of equity was 10.1. I multiply that by 391.8 over 408.2. The cost of the preference share was 8.9, which I'm going to multiply by the value of the preference shares, 2.8 over 408.2. The cost of debt for the loan note we've just calculated to be 5.6, which I multiply by 10.5 over 408.2. And then the cost of debt for the bank loan, we suggested, or we didn't suggest, it's 5.25 times 3 over 408.2. The reason why I keep these individual is if you make a slight error, the marker can reconcile where your mistake was made and then just simply deduct a half mark rather than deduct the 2 marks that are available. So 9.69. .06 0.14 and 0.39. That gives me 10.28%. How can that be? That cannot be correct. I have made a slight error and I know where it is. It's just down here. You cannot have a weighted average cost of capital higher than an individual component. 3 shared by 408.2 times 5.25 is, right, there's my error, that's 0.04. I mean, as the equity is the dominant, vastly dominant element, it should be very close to the cost of equity. And it's 9.93. Our weighted average cost of capital is 9.93. Okay. If there's any issues or concerns, please let me know. Otherwise, okay, before we proceed, let's just reconcile here. This question has enabled me to cover a large amount so bear with me. I would like to reconcile, so this evening, in the question we did before break, we covered capital structure and I spoke to you about traditional, Modigliani and Miller and no tax. Just now we've seen the preference shares, I've seen a bank loan and I've seen a redeemable where we use the IRR formula. We have calculated dividend valuation model, we didn't use the growth, and we've calculated the market value in this regards. What we did prior to our break was we looked really in essence at implications of raising new finance. I am just going to deal with the elements that remain from this question before we move on, because I want to be able to calculate a project specific cost of equity with you. In this question it says discuss the connection between the relative costs of sources of finance and the creditor hierarchy. Well, which of these was the cheapest out of these elements was the bank loan. The most expensive is the equity. Is there a connection between the cost of each of these sources and the creditor hierarchy? Well, yes, absolutely there is. The creditor hierarchy is the way in which debt providers, or not debt providers, providers of capital stand if the company were to go into liquidation. Who stands at the front of the queue? Probably the bank loan, because they've probably got that loan secured against the assets of the business. And they therefore have taken the smallest risk. They are at the front of the queue at the creditor hierarchy and subsequently they get the lowest return. The loan notes are probably going to come before the preference shares, which will come before the cost of equity. In the event of liquidation, the equity investors are at the back of the queue and subsequently take the greatest risk. Therefore, they demand the highest return. And that, folks, is the reason why equity is always more expensive than debt. Here, we are required for three very short marks to explain this. So, how would you plan and execute? Well, you do an introduction, and your introduction would subsequently enable you to talk about the cost of finance. And what I would want you to talk about here would be that equity is always more expensive, whereas your debt is cheaper. Then I would want you to discuss the creditor hierarchy. And say it determines and finally we talk here about the relationship between the two. Okay, so there's your 3 points to build your answer to score your 3 marks. Beyond that, we're asked to explain the difference between Islamic finance and other conventional finance. So here, I would explain Islamic finance, and I would link in the concept of riba. And I would note that it is prohibited. And then I would discuss how returns are generated. And then I would talk about how conventional finance is paid regardless of performance. And then perhaps 1, 2, 3 points, I'd finalise by saying that Islamic finance only available So 4 points, 4 marks. Let's move on. There's 2 questions that I have next. Okay. Can we squeeze these both in? I'd like to for coverage, but subsequently I'm going to just extract on a form of question. We're going now to June 2014. We're going to go to question called fence. Okay, I'm going to leave you to digest this for a moment and then I'll come back. Let me leave you for 2 minutes. Okay, so my reason for... Oops, what's happened here? Ah, that's good. Okay, you're back. Right. My reason for choosing this question is because it gives us the opportunity to do project-specific cost of capital and to deal with the capital asset pricing model. I'm not going to answer the whole question. The issues here in part D is to do with valuations that we'll discuss on Thursday, perhaps coming back. The issue here about systematic and unsystematic risk in relation to portfolio theory and the capital asset pricing model, well, that's quite a tough one for 6 marks because I don't believe there is that much to be said. However, systematic risk is unavoidable and unsystematic risk is. Unsystematic risk is industry specific and an investor will diversify their portfolio to ensure that they eliminate this risk in its entirety. The systematic risk that remains is what determines our beta factor, and that is containing both business risk and financial risk. Financial risk is relevant to the debt in the capital structure, and the business risk is in which we operate. Now, the current weighted average cost of capital, I'm going to pass this over to you to practice in your own time. Market value, cost of each source combined. There is only two. The equity beta of Fence is 0.9. They have 10 million ordinary shares, the market value of which is 7.5. The company has 7% bonds with 100% nominal value, which are redeemed in 7 years' time at that $100. The bonds have a total nominal value of 14 million, and the interest on the bonds has just been paid. Each bond is trading at a 7.14% premium, meaning it's 107.14. You would have to follow the 4 steps that I showed you in that last question. That's what I want you to practice. What you haven't perhaps seen is how to calculate the cost of equity. So let me show you ever so briefly. The cost of equity is the risk-free rate plus the beta times the risk premium. That's the capital asset pricing model. Now the risk-free, we're told, is 4%. The beta, we're told, is 0.9. And the risk premium, well, the RP, can you see that, equals RM minus RF. RM is given as 11, RF is 4, so that gives us 7. 0.9 times 7 plus 4 will give us 10.3%. Okay, let me talk around this cost of equity for appraising the new project. Here, we're told that they plan to invest in a different to existing business operations. That goes back to where I started this evening with the question of when is it appropriate to use WACC. We always use WACC unless where the project has a different business risk. Now this clearly has a different business risk. Subsequently, we use the project specific, and what we do is we locate a proxy company, which we have done, and we assume their equity beta, and we de-gear based upon their market value of equity and their market value of debt. Let me demonstrate, and perhaps this is only calculate, but I'm going to amplify my answer to ensure that you are aware if this was a written procedure as well. Step number 1, locate a proxy company that operates in our target market. So we do. Our proxy is HEX, and we take their 1.2 equity beta. Step number 2, we de-gear to remove their financial risk. And we do this by saying the asset beta is equal to the equity beta multiplied by the market value of equity over the market value of equity plus the market value of debt multiplied by 1 minus t. So the equity beta is containing business and financial risk. And for HEX, HEX has market value of equity of 54 million. We divide that by 54 plus their market value of debt is 12, and the tax is 20%, 1 minus t being 0.8. And that provides us with 1.019. That is the asset beta. Next, step 3, we re-gear to insert our financial risk. And therefore what we say is the equity beta is equal to the asset beta multiplied by the market value of equity plus the market value of debt multiplied by 1 minus t divided by market value of equity. Now guys, I'm showing you figures here that you would calculate it for yourself already in part A. But what I'm going to be doing is I'm going to take that 1.019 and multiplying it by 75 plus we have pretty much 15 million divided by 75. And that gives me 1.182. So fourth and final step is we calculate the project specific cost of equity. And we do that by taking the risk-free rate of return plus our beta times our premium, which I think we've already said is 7%. And I'm going to declare a project-specific cost of 12.3%. So that's how we calculate the project-specific cost of equity. Okay, final question of the evening. Final question. I'm going to take you to December 2014. I'm going to ask you to go and read question 5. Okay, can you see that okay? Yes, you can. Take a couple of minutes and we shall attempt this question. Okay guys, rationale behind this question is because it demonstrates, it facilitates rather, my ability to show you the difference between the book value and the market value, which the examiner has challenged candidates on in recent times. The book value of WACC will always be lower, has always appeared to be lower than the market value as a consequence of the book values distorting the capital structure and undermining the actual value of equity. If we look at this question, we can see that the book value of equity is 850 and the book value of debt is 200. But if we recognise that TYNEP has a nominal value of 50 cents per share, subsequently they've got 400 million shares in circulation, and each of those shares are currently trading at 585, then we've got a market value of equity of $2,340 million. And the loan notes are trading at 103.5, so they are subsequently trading at a premium. So the market value of debt is 207, giving us 2547. But look, the percentage of equity here, 2340, shared by the 2547, that suggests we've got 91.9% equity. But over here, 850 shared by 1050, we've got 80.9% of equity. Now, as you know from my comments about the creditor hierarchy, the cost of equity is always greater. So using the book value, we're going to be undermining the equity. Using the market values, we're given its correct representation. Calculate the market value, WACC, and the book value, WACC, and comment briefly on the difference between the two values. So I've done the market value stage, I've done the book value stage. We now need to calculate the cost of equity, where we have an equity beta of 1.5, a risk-free rate of return of 4, and a risk premium of 6. The loan notes, once again, and this is where a lot of time but some subsequent marks comes up, we've got to do the four-step approach. Interest is 6%, tax is 25%. They are going to be redeemed in 6 years at a 6% premium. So you're going to see this for a second time. So the exam paper is December 2014. So question 5, TYNEP from December 2014. I am going to show you, because I've done on the face of the question the book values and the market values, the cost of equity. The cost of equity is that risk-free rate plus the beta times the, notice in this question it doesn't give you the market, it gives you the premium of 6. 1.15 times 6 plus 4 gives us 10.9%. For the cost of debt, step number 1, the interest. The interest here is $6 because it's a 6% loan note times 1 minus t, that again gives us 450. Step 2, the NPV now at 5%. Something different happens here. Year 0, our market value is 103.50. In year, this redeems in 6 years. And in 6 years, it redeems at a premium of 6%. So it redeems for 106. Cash flows, discount factor at 5%. Take care because we're looking at 6 years now. 158 negative. Now I'm pleased to show you this because I'm subsequently going to do a second discount factor at 1%. Because as I said to you previously, if it's positive we go up to 10, if it's negative we go down to 1. So 0.942 and 5.795. $22.43, meaning low is 1 plus 22.43 over 22.43 plus 1.58 times 5 minus 1 . That gives us 4.7%. So we've seen that for the second time. What I'm now going to show you is over here the book value and over here the market. So the book, the cost of equity, 10.9 multiplied by 850, you must include the reserves, over 1050, or multiplied that 10.9 by 2340 over 2547. The cost of debt we said is 4.7 times 200 over 1050, or multiplied by 207 over 2547. So what can you see? Well, what you can see is that the book value is lower than the market value. And the reason behind that, as I stress, is because we are undermining the proportion of equity in our capital structure. And subsequently, that could lead to bad investment decisions, because we are not correctly, or rather, should I say, the higher the weighted average cost of capital, the lower the NPV. So basing it upon the market values ensures that we are generating the return required by our investors. This here is more realistic, and this should be used in investment appraisal and NPV decisions. Whereas with the book, this is artificially low of equity. Okay, my throat is beginning to seize up. I'm going to ask you for a moment now to take the pressure off me, to just look at part B and have a think about that for 60 seconds. Part B. Written questions. Written questions such as this. There is a wonderment here, folks, because the word factors means it's open. What factors should be considered by TYNEP in choosing to raise funds via a rights issue? My advice to you is this: do not talk about anything other than a rights issue, because if you were to, you'd be providing a non-relevant answer. There is no need to talk about debt. What you need to talk about here is a rights issue, an issue of new shares to existing shareholders. And subsequently, what you should be discussing is perhaps the likelihood of existing investors wanting to put more money into the business. So the likelihood of acceptance by current equity investors would be my first consideration. Secondly, I would think if they weren't to accept it, the impact upon our ownership, because we could find there is a dilution if only certain investors were to acquire. I would consider the required discount to entice investment, the required discount to the share price, I should add, and I would also consider the impact upon the share price post-issue. And to that I would link two things. One, what are the issue costs, because they will erode the share price. So if it's too expensive, we shouldn't continue. And two, what is the intended use of the funds? 1, 2, 3, 4. We need to stretch it slightly more. I would think perhaps then on the impact on gearing and the weighted average cost of capital. That, guys, I think would provide you with a decent answer to amplify those points to get your written marks. Okay, I am at the point now where I'm open to any issues or questions, Mwemba or Lorraine, you may have about tonight's topics. Tonight's topics, remember, we are covering the all-important business finance, including cost of capital. Business finance, including cost of capital, is highly likely to come up in Section C. In fact, there is a good chance it could come up in Section C. We have touched upon this evening a number of things. We've seen rights issues, we've calculated TERP. The value of a right I'm going to calculate in a moment with a multiple choice question. We've spoken to some extent about considerations when choosing debt and equity. We haven't really discussed financing for a small or medium-sized enterprise. What I would say there is recognise if the question is asking you how to raise funds, but the scenario company is deemed to be unlisted or small, because you cannot raise debt or equity. They would have to look at some alternatives to raising funds. We spoke briefly about Islamic finance. There are some more questions which I recommend you practice. We've looked at the cost of equity, the cost of capital, the cost of debt. We've looked at project-specific discount factors, and we've had a good look at most of the recent exam questions. If there's anything that you feel that we have not covered that you would like to see covered, please do so now. In addition, I just want to draw your attention to some of the things that we've done this evening in terms of the financial management function and environment, we have looked essentially how to finance a business. We have also, to some extent, seen some ratios such as return on earnings per share. We have seen a dividend payout, and we've calculated an interest cover, and we've spoken about debt in the capital structure. Okay, I am... Lorraine, hello! Almost to the end. It's quite challenging for me. What can I do to make it easy to understand? Earnings per share is simply... Let me explain. And there was me thinking that you weren't really listening. The earnings per share equals our profit after tax minus any preference dividend, if there is such, divided by the shares in circulation. Now, if truth be told, this isn't really an entirely useful measure. There are better measures out there, but what it's looking at is the number of shares and the earnings each share is, or the earnings attributable to each share. And what we want to see is that it grows year on year. Now, how can you understand it? It is simply telling us how much earnings we have for each share. And let me just introduce you to the P ratio and show you something just here. Okay, so this is linking it and just showing you how it's not that important. I've got company A and company B. I've got a share price of £4 and £2.50. You are perhaps inclined to think company A is better. I am now going to tell you that the earnings per share of company A is 50 and company B is 25. That will reinforce your opinion. However, if we divide those two, that equals the PE ratio. And the PE ratio is 8 versus 10. The higher the PE ratio, the greater the confidence in the business. And what you do not know, but what I'm about to tell you, is the shares in circulation for company A is 10 million, for company B is 20 million. And therefore, the earnings per share times the shares in circulation shows you that these two businesses have total earnings that are the same, 5 million. My point being, Lorraine, earnings per share is devalued because two companies with different shares in circulation will have a different earnings per share. And really, the only valid measure of earnings per share is just to look at a business's performance year on year. How can you understand it? It is simply the earnings divided by the shares in circulation, which is a consequence of how many shares a company has issued, and will be distorted after a rights issue because the number of shares in circulation will increase. Easier to understand. Practice. And look at different questions in the context in which the earnings per share is calculated. Does that give you a crumb of comfort? A little bit of clarity on what it is? I mean, both of you, if you have any issues, that's not my email address, is it? No. If you have any issues and you want to liaise me, you can talk to me via Canvas, but you can also contact me via email as well. I wanted to show you, and this is on the most recent exam paper, something that's linked to what we're doing here and now, is TERP. I don't know if I actually made this available, did I? No, I didn't. On the most recent exam paper, which is the September paper, there was this question. Have a read of that question, please. So this is TERP, Theoretical X Rights Price. What we've got is a company with 4 shares currently worth $8. And they're going to issue 1 new share for $6. Giving us 5 shares now worth $38. So the TERP would be 38, share by 5 is $7.60. The issue price was $6, so the value of a right is $1.60. Now, you would be forgiven for answering this question as part A, but I can tell you it's incorrect because you're asked what is the theoretical value of a right per existing share. We have to divide that by the 4 existing shares, and that gives us the correct answer, which is B, 40 cents. The value of a right, we've seen TERP this evening, but we haven't seen the value of the right, so I wanted to show you that question to just ensure we've covered. Anything else? Mwemba? No? Okay, I'm going to draw ourselves to a close. This evening, what I've intended to cover from the syllabus is this. We've tried to look at cost of capital. We've spoken about capital structure theory. We've seen project-specific discount factors. We've spoke briefly about various sources of finance. I mentioned about small and medium-sized enterprises and the alternatives. Theoretical understanding of the implications of a rising cost of capital. I haven't really touched upon that, but if our cost of capital is to rise, the value of our business will fall because the present value of future cash flows will decline. On Thursday, when we next meet, we're going to be focusing on 2 topics which my classroom students have told me over the last 4 days they're not very happy about. That is foreign exchange risk and interest rate risk and valuations. So can you guys have a little look at those 2 topics in advance of Thursday? Otherwise we'll be doing exam questions focusing on valuations and risk management. Otherwise, have a pleasant evening. I will see you in 2 days' time. Gosh, Lorraine, you've got one in right at the end there. The project-specific cost of capital, yes, is absolutely the same as a project-specific discount factor. What I must stress, the calculations I did this evening is we only calculated the project-specific cost of equity. If you wanted the project-specific cost of capital, you would have had to have calculated the cost of debt and attached that towards the end. But the examiner has said he will only get us to calculate a project-specific cost of equity, not a project-specific cost of capital, but theoretically you do have to be aware of that. Okay, but yes, they are one and the same thing. The cost of capital would be that discount factor. I hope that makes sense. Okay. By the way, gosh, have you guys seen the articles on that? I am an advocate of making sure my classroom students have access to these capital asset pricing model articles. If you've not seen these articles, which are on the cost of equity, there is one on the the capital asset pricing model, and one on project specific discount rates. If you haven't seen them, please email me and I'll get them across to you. Otherwise, I look forward to seeing you on Thursday. I won't be in classroom during the day, so hopefully my voice will not be as strained as it has been this evening. I'll see you in 48 hours' time. Have a pleasant couple of days. See you on Thursday, guys.